Hello and welcome to Dialogue. As government deficit spending hits a legislated cap, the Biden administration had grappled with lifting the debt ceiling. That's a limit the U.S. House of Representatives last set at $31.4 trillion in 2021. Now there's a little time and wiggle room as the Treasury Secretary Janet Yellen warned of a possible default as early as June 1st. The Republican-led House is not about to budge on the debt ceiling, at least not without extracting concessions from the White House on spending cuts. Without a compromise inside, could this lead to a debt ceiling crisis similar to the one in 2011? Why keep the debt ceiling at all if it has fallen short of reining in public debt? And what are the dire consequences for U.S. debt default? To answer these questions and more, I'm joined by Einar Tangen, independent current affairs commentator, Anthony Chan, former JPMorgan Chase chief economist, and Dai Xianfeng, a portfolio manager. That's our topic. I'm Xu Qinduo. Well, welcome to Dialogue. And I will start with you. This is a hot topic. Whether to raise or abolish, suspend even the debt ceiling. First of all, what is a debt ceiling? Why there is a debt ceiling in the first place?
Well, they decided it's to stop me before I spend again. It's basically what it comes down to. The law's been in place for a long period of time, and basically it says, you can't borrow beyond a certain limit, and that has to be approved by Congress. Now, it is within Congress's purview because the Constitution's call for all finance bills to go through it. So they're the purse of the United States. But there's a larger issue here, Qinduo. I mean, if you look at it, since 2001, the U.S. has been running a deficit. Since 2009, it has, in essence, tripled its deficit. Now, if we were to take the U.S. government out of the equation, I would tell you, I would describe this as a Ponzi scheme. Basically, you're borrowing money to pay off money that you don't have.
Mm-hmm. So, okay, Anthony, there's a real issue of the rising debt. So probably in that sense, the debt ceiling, the debt limit, does have a significant meaning or function here.
Well, it is an opportunity for both parties to negotiate on how much faster you allow that debt to grow. But you can't lose sight of the fact that we're arguing about whether to pay the debts that were already incurred. This is not really just about future spending, even though in the negotiations it's about future spending, but it's about should we pay all the obligations that we've already incurred? And I think in that sense, it should not be a debate. We should always pay our debt. And then the second question would be, do we want to talk about how much faster to grow that debt? That's the way to proceed in my judgment.
Thank you for the breakdown of the issue. Xianfeng, of course, there is a bill. As the biggest economy in the world, of course, you don't want to lose the credibility. I will pay the bill. But if there's a default, what are the consequences for the U.S., for example?
The immediate consequence would be pretty severe. It really never happened before. And you just look at the history, when the market, look at the market volatility back in 2011, that gives you indication of what's going to happen. The equity market is going to go down. The rates probably going to go up at the beginning, but as the impact for the global economy began to present itself, ironically, the U.S. Treasury yield could go down again. Dollar could go down as well. There will be a lot of volatility
but basically,
if it happens.
Right. So, Anna, if there is unprecedented default here, something similar would be 2011. If I'm not wrong, there's a few days, for federal workers even to be laid off because we are not able to pay. Right? How big an issue is that?
Well, it's a huge issue. But it goes way beyond anything that is going to happen internally within the government. You have to remember that 75% of this debt is held by U.S. individuals and institutions. Only 25% is held internationally. There, I would agree with my colleague, there would be a run on the dollar. You really see some very sharp reactions to this. Remember, U.S. is 4.5% of the world's population, but consumes 20%. If 5% of that went away, all right, it would have devastating impact on the world. And you'd see the world plunge not into a recession, but a depression. The U.S. would lead the way. But it's kind of one of these things where you have these two political parties basically trying to rearrange the political deck chairs as the Titanic is sinking. It's almost unfathomable to people outside the United States that they would be this irresponsible in terms of what's happening globally, and that goes to the Fed raising rates as well. I mean, a lot of the problems that we currently have are the fact that they made the safest asset in the world, the U.S. Treasury, into a toxic asset in the space of a year.
Hard to believe, right?
Yeah.
Xianfeng, so this is obviously there will a big impact on the U.S. as well as the economy. But the thing is, 2011, the U.S. avoided, let's say, an official default. But why this time around the people are paying so much attention to that? I would say many people probably would be, as they say, quietly optimistic. At the last minute, there will be a deal to avoid default. Is that the case?
I think the baseline would be the case. Right now, you look at the market participants, the market players. That's exactly what you said. Everybody was worried. It's really the topic of the day. I'm portfolio manager. I manage money. If you talk to investors, that's really what has been on their minds almost all day long. And then you look at the markets. The markets behave a little bit different, right? The equity market has been pretty resilient. Take S&P 500 index, for example. And then the only thing that kind of reflect this would be the rates market, the Treasury, U.S. Treasury markets, right? The Treasury yield. It kind of go down a little bit.
Yeah.
Also the dollar kind of go down. Right?
So you are basically saying that even, the talk of it, the time running to say the deadline, for example, June the 1st, even the discussion, even the talk, the coverage of this issue is creating some chaos. Can we say that? Not chaos, probably.
Yeah. Potentially you could, as another logic behind potential market volatility, meaning when the two parties, it's game theory, almost like a game theory scenario. No one wants to, back down. Now it probably takes significant market volatility to really convey the seriousness of this, and then push the deal in the final minutes. Right, that's another logic. When the markets look at this, the market does not do this on purpose, but the end result probably will be like this. Right, it takes a significant volatility to reach a deal.
So Anthony, so obviously this is an issue. That's maybe budget issue or economic issue or market issue, but at the same time, it's a political issue. Tell us how different is now in terms of politics, in terms of probably, overall environment, for example, atmosphere. How different is it from 2011?
Well, I think that the degree of polarization in the United States today is much greater today than it was in 2011. And that's the reason why so many people are talking about it, because it can make them nervous. But with all the scenarios that everyone is discussing, they're all true. It could lead to disastrous situation. But you have to keep in mind that the question is, does the U.S. default for 12 hours, 24 hours, 36 hours? The worst case scenario is that default just lingers on. Chances are that if you get a default, it's very temporary. And people can talk about all the different scenarios. You won't pay the interest on your debt. But that is kind of silly about not paying interest on the debt, because if you look at the amount of interest payments, it's a small fraction of the revenues the government receives. So they can easily pay the debt interest rates and continue to move on. What will change, of course, is how much the government can spend on goods and services and laying people off. And if you look at that, because you can't borrow money, then you can cause real GDP in a given quarter, if it lasts for a protracted amount of time, to drop anywhere from 6 to 8%. That's a possibility. But the question is, does anybody really believe that if the federal government defaults, that it will last months, quarters, years? Of course not. It's not going to last that long. It'll be resolved. And so these scenarios are all true about doomsday, but it all depends on how long or if the U.S. government defaults in the first place. Because yesterday, the last 24 hours, the Senate minority leader, McConnell, said there is not going to be a default. And even McCarthy, who's really been really aggressive at fighting this debate, has said there's not likely the U.S. cannot go into a default. So, and of course, the president said absolutely no default. So with all these voices being heard, I think that the odds of a protracted default that lasts an indefinite period of time that can really lead to all these doomsday scenarios is a bit of a long shot.
Anthony, are you saying that, the leaders from the Congress, of course, the president, they are trying to present an image of being responsible in terms of the budget issue or the deficit issue here?
I think that they're both trying to further their negotiating positions. Obviously, the Republicans want a severe cut. Some are talking about cutting government expenditures by 5 to 1% increase with an inflation rate of growing 4 to 6%. We know that's real deep cuts. It's going to be very painful. And in a polarized political environment, the opposing party does benefit if you cut government expenditures. It slows down the economy. Then you can blame the incumbent political party for the slowdown in the economy. So you can see these political dynamics at work here.
So Anna, you are waking your, shaking your hand?
Well, I mean, the U.S. Budget is basically 60-39, and 60% is, mandatory expenditures, 30% is discretionary, and about 9% is for the debt. So it's not a small number at all, and the idea that it could violate, the terms of the repayment is something that's going to affect a lot of people. Back in 2011, they estimated back then, remember, the deficit has tripled since then, that it cost $1.4 billion immediately, and then it had long-term significant effects when, I think it was not Moody's, but S&P downgraded the debt. So this is not something, and you can talk about it's temporary. This is not temporary. What you're dealing with is the full faith and credit of the United States. Remember how many trillions of dollars are floating around the world, all right? And it's all based on this idea that it's a safe currency. But between the interest rate hikes, the inability to deal with this factionalism, and the fact is, and I agree with Anthony on this, it's politics. They're all gearing up for the 2024 election. Who can blame who for what's going to go bad? But no one has a plan how to do better.
But for the Republicans, they're asking for spending cuts. I think there's a point, because obviously the debt, given how rapidly it has been increasing, from what you said, 1990s or 2000, early 2000. So, it's unsustainable, let's say.
It's unsustainable, but then you have to get into what is the definition or the role of government. You have 10.1% of the people under the poverty line in the U.S., all right? You have homeless people, what everyone is talking about. You're saying that there's tremendous social issues, and you say, well, we can't pay for those, right? We can pay for massive increases in defense spending and missiles. It can send billions of dollars, approximately about $5 billion a month, to Ukraine, but they can't figure out how to run their own country. So at this juncture, people are looking at this, and the reason I said it's probably controversial is that barring this if this was not the U.S., if it was some other country, the markets would be saying this is a pure Ponzi scheme. They're just borrowing money to pay money they don't have. So, at some point, this is going to erode the full, the sense of the U.S. as a rock. You're already seeing de-dollarization happening, and it's a shame because there's really nothing that can take over from the role of the dollar in a crisis. It's going to be a patchwork at best, and it's going to have tremendous repercussions on the international economic scenario.
Mm-hmm. Well, Xianfeng, of course, this is a topic not only limited inside the U.S., but also you look at the global community. People are also talking about that as we are covering this issue, because obviously, 25% of the debt comes from overseas. Biggest holders like Japan, China, for example, they are also concerned with the situation. In what way they will be impacted?
Like Anthony just said earlier, I agree. Default, if ever happens, most likely it's technical default, right? Probably a couple of days at most. It'll be temporary. So the debt itself, in terms of the losses, the interest paid or principal paid, I don't think that's a big deal at all. People are gonna get paid. Countries. The impact mostly will be through the asset price. The equity markets could go down. The yield could go up. Therefore, the Treasury bonds price could go down. So you get a hit by valuation. Another layer after the financial market volatility, potentially, the real economy, the global economy, could get hit as well. Right, so that's really what I think the worst case scenario. The money, the people are going to make a whole. The U.S. government is not, it is going to pay the interest and principal at the end of the day.
Mm-hmm. But still, the debt issue, it is a big issue, right? If you look at probably right now, it's $32 trillion, and it will increase for the next few years or next decade. It will be much, much larger. Are people worried about whether the U.S. will be able to pay off the debt?
Yeah, the debt issue is a complicated topic, right? So U.S. right now is number 2 after Japan in terms of debt to GDP ratio. Japan is the highest. So Japan, has like 255% of GDP. U.S. right now is anywhere between probably 130 to 140%. That's a lot. As my colleague said earlier, it increased a lot during the past few years. But where is the limit? That's really the problem, right? So there's an academic study about this before, saying maybe 77% will be the limit in terms of. If the debt exceeds 77% of GDP, it might begin to impact the growth, to slow down the growth. So that's where the study comes from. Another indicator would be inflation, right? That goes to the modern monetary theory that became popular a couple years ago. So before 2022, there's no inflation in U.S. Therefore, people saying, okay, the Federal Reserve can carry on with a loose monetary policy, right? And the deficit is fine. Since 2022, inflation become a problem. So this could be an indication of the debt limit as well, right? So overall, I would say 130, 140% of GDP. That's pretty high. But as long as the inflation, is under control, it probably that's going to be okay. Japan is one example for the advanced countries.
Okay. Anna, you disagree?
Well, inflation isn't under control, okay? And we already saw what the Fed increases to rates did to banks, and is continuing to do to banks. So, by my colleague's scenario, if increase in rates goes up a lot, those treasuries are even more toxic. So everyone holding them is going to take a haircut if they try to sell them. And my colleagues are talking about the very short term. All right, And I was an investment banker at one time, and I understand that you look quarter to quarter, maybe a year in advance. But we're really talking about a long-term situation. This has not been something that happened yesterday. It's been happening over the years. I keep saying, deficit tripled, all right? The borrowing deficit tripled since 2009. That is a scary thing, given that every year the U.S. has been in deficit. So they haven't been meeting current obligations. They've tripled their debt, and they're now in a situation where they're literally going to have to borrow to pay the interest on the debt. Remember, by increasing the rates, that affects the U.S. government too, because they have to increase the amount of money that they're putting out. They're doing some fiscal things, monetary things, to control that by trying to release more funds into the market to drive down the prices. But that only lasts for so long. I mean, you can have gimmicks and tricks. You can talk about getting to crisis and getting over it. But long term, the U.S. is in a very bad situation because it doesn't seem to be able to address the very things you were talking about in terms of what is the future for the U.S.
Mm-hmm. Anthony, what's your understanding? What's the future of the the debt issue? And also there's a related issue like whether this default or this debt issue somehow erode confidence for global investors in the U.S. That's Treasury, for example.
Well, there's no question that a default or even the possibility of default does erode confidence. But you have to remember, since 1960, we've increased the national debt ceiling 78 times. So we've been on this road before. I don't disagree with the view that we have a problem with the debt and it's growing uncontrollably, and we need to do something. Because what happens, if you want to take the long-term position, is that over the last couple of decades, what we've seen is that during good times, Republicans want to cut taxes, which increase the deficit. I know they argue that it pays for itself, but those results have not shown to be the case. And the Democrats want to increase spending because they want to help all the problems that have been discussed today: homelessness, social inequality, things like that. And then during rough times, then everybody panics, both Democrats and Republicans, and they want to stimulate the economy. But again, that scenario says the deficit gets bigger during good times, and it gets even bigger during bad times. And over the long period of time, you have exactly the scenario that's been described, that we have an uncontrollable increase in the debt situation. But as you heard before from one of my colleagues, our national debt is bad, but in Japan, the debt to GDP ratio is not a little worse, it's twice as worse. The ratio is, it's a 2x compared to the United States. So yes, we're getting worse, and yes, we need to fix it, but it's even worse in Japan. And so far, Japan seems to keep going. Not to say that that's a reason for complacency, but that's a fact.
Anthony, we talked about the politics. It's more like a political issue here, the Republicans and Democrats. I mean, how likely this time around they are going to strike a deal at the last minute to avoid default or probably to keep just to have a short period of time, technical default, and then they will focus on the debt issue or the deficit issue. Long term to avoid probably the sharp increase of debt?
I hate to disappoint you, but politicians never think of the long term. They always think about doing everything at the last minute. If we get a deal, it'll probably be in the last 2 weeks before June 1st. If we don't get a deal, it'll be to extend the debt ceiling maybe 3 to 6 months and then fight it again. So I wish that politicians on both sides of the aisle would think long term, as your question implies, but they don't. And that's the reason why the U.S. has such a serious problem, because there's nobody out there, Democrat or Republican, that thinks long term, and they should be.
So they're not thinking long term, but they are going to meet again on Tuesday. President Biden met Kevin McCarthy from the Speaker of the House. So they are going to meet again on Friday, but their aides are meeting on a daily basis. So can we expect any short-term solution or any agreement?
No, I don't think so. I think if anything gets put together, it'll be in the last day, hours of the things going critical. It's basically a game of chicken. Two cars driving at each other, who's going to swerve first? Who's going to blink? And that's the game of politics. I was a politician, I remember it quite well. But it doesn't serve the people. And that's one of the real issues that we have here, is that the U.S. is undermining itself because it doesn't have a long-term plan, as my colleague pointed out. The deficit goes up during good times, deficit goes up during bad times. So what's the solution? And I don't agree that saying that somebody's worse than us and they're still alive. I don't agree. Imagine if the IMF came to the United States, all right, and what would they prescribe? They'd say, right. Austerity, you need to get your house in order. But apparently that prescription is only for other countries, not the U.S.
Particularly for developing countries, they are in trouble, right? I want to have you guys comment. Here's a comments from the Economist magazine focusing on this issue. Here's a quote, that America requires a serious political debate and bipartisan agreement to put its budget on sounder footing. Alas, its leaders are inclined neither to seriousness nor to agreement. So the lack of seriousness?
It's not a lack of seriousness. There's a fundamental misunderstanding. Politics in the U.S. is ground up. Everyone is looking at their constituents and how they can get reelected. So, long-term thinking isn't part of it. You've seen this with populists. Trump promised that there was going to be nirvana, that the United States would be #1, that he was going to make it into winner. Remember, he said, you're going to be so tired of winning, all right? Well, so far there haven't been any wins. And there isn't anybody looking long-term, and I agree with Anthony on that.
Mm-hmm. So Xianfeng, so basically it's just probably will be a temporary problem, but long-term it will be fine. At least, the can will be kicked into the future.
Yeah, that's the baseline. I think the market reaction so far is okay. 2011, that's probably the first time the U.S. got a serious debt ceiling problem. By now, I think the market is sort of getting used to it. Has been building relatively optimistic expectations as of now. So anything happens, that's going to be temporary. That's the baseline scenario.
Okay, Anthony, there's a talk of the 14th Amendment. Basically, the president will resort to this power to bypass this debt ceiling authorization from the Congress. How likely is it? And how, maybe that's obviously very controversial?
It is very controversial, and it's a last-minute, last resort, break the glass type of option. Because first of all, to use the 14th Amendment to say that the debt should not be questioned, which is what the 14th Amendment says, that's going to be challenged in the court. And if it goes and gets dragged through the courts, the financial markets will panic even more, because there is the perception, whether it's correct or not, that the courts are more conservative and are going to be favoring the Republican position. So the financial markets will get nervous. So it is the absolute last resort. Same thing with the platinum coin type of option that people have floated around, that somehow the Treasury can issue a $1 trillion coin, deposit at the Federal Reserve, and then all the problems go away. These are all crazy solutions that are last resort.
Crazy solutions. That's why Janet Yellen called it, it could be a constitutional crisis if the president uses 14th Amendment.
I was a lawyer. I remember enough about constitutional law. This would be fast-tracked. If he invoked the 14th, it would be fast-tracked to the Supreme Court. Given the makeup of the Supreme Court and their literalism, they would not allow this to go through. So I would agree. Markets would be in turmoil. Nothing these things. You could put it off for a little while, but the crisis remains.
Crisis will remain. Well, on that note, we come to the end of today's show. Many thanks to our guests. You can also find us on the CGTN app on YouTube. I'm Xu Qingduo. Thanks for being with us. See you next time.